Hi Akshay. I'm Aalesh, and I'm the co-founder of CreditWise Capital.
Alice, can you give me an elevator pitch of CreditWise?
Sure, Akshay. CreditWise Capital is an NBFC with a first focus into two-wheeler financing. Um, we are trying to disrupt the two-wheeler financing space by using technology as an enabler. And we are into two other major verticals. One of them is cross-sell, and the other is technology, where we have productivized our tech stack and we provide it as a SaaS in the BFSI space. So today, CreditWise Capital is an full stack lending solution with NBFC on the holding company and a technology subsidiary under that.
Okay, interesting. Um, Building an NBFC is not an easy thing to do. I found it interesting that you did not start by saying CreditWise is a fintech, but you said CreditWise is an NBFC. You also understand the value of being an NBFC. Just help our listeners understand, why is building an NBFC hard? What's the value of being an NBFC?
NBFC is actually a business of collection. It's not the business of lending. And I think fintech usually have the lending first approach, but NBFC is a collection first approach. Collection is usually an unsexy part. So if you have that mindset, NBFC is your business. And if you have the former aspect, if that's the thought process, then the fintech is your part. And so I think each has their merits, but recently, with a lot of tailwinds coming into the regulatory concern, obviously NBFC or a regulated entity has become like a darling, has become more favorable, and each has the cycles. But I would say, to give it an all, a tech business might be slightly easier than business building a profitable lending business the first with a clear focus on collections.
How old are you?
So I will be turning 30 in mid of this year.
Okay. How did a 30-year-old build an NBFC? Give me like a
So
little
just
bit of a origin story.
okay. So I'm from Bombay, out and out uh, studied here, but I went for my education to Boston, double major in computer science and finance. Worked in private equity straight after college. I was fortunate to skip the whole investment banking phase. Um After that, worked there for almost 3 years and realized the amount of money into alternate asset class in America and knew it would trickle down to India at some stage or the other. And came to India in early 2017, knew I wanted to do something in the fintech space. Raised decent capital from family offices from all parts of the country. Wanted to do
How? Like,
so.
I
In
mean,
fact,
that's like,
in fact, I had my first commitment on my flight back from America, and why on LinkedIn itself. It was all LinkedIn cold outreach, and I would say till date,
what was your pitch there? What were you pitching to the investors, to the LPs?
I would still say that probably those 8 9 months of fundraising as a 23-year was probably the hardest part, at least in my short journey. And it was more about, because more than fintech, startups were just about scratching the surface. Fintech was unheard, but it sounded sexy. A lot of family offices wanted to get into this aspect, where they wanted to diversify their asset class, where they also probably wanted to digitize some of their core businesses. So it did make sense. They all wanted to be involved. So that was my pitch, where we would, usually it would be, then maybe these are certain opportunities. I shortlisted a few. These are some opportunities that are brewing in the space. Uh, and would love to help diversify your asset capital into this asset class. Uh, had way more no's than I can even count, but it was all about finding that
One,
one
one,
yes.
one question more about the pitch. Uh, were you pitching this as like a alternate investment fund? Was that whole structure around
Yeah,
at that time?
no. So it was, I kept it as an LLP structure.
Okay.
2017, the whole AIF structure had not even been around, and even if it was around, there was a lot of more regulatory, a lot of more paperwork. So I kept it as a very lean LLP structure. And because my focus was to invest in companies in India and not abroad, so LLP was the way to go at that time.
Okay, understood. And how much did you raise total? Like, what did you
So I had raised
envisage?
a total of about $6 million
Okay.
back
How
then.
much in crores? About
That would be around at that time was around 40 CR,
40 CR.
45 CR.
Okay. And what kind of stage were you investing in?
It was literally pre-seed A to Series A stage, Akshay. It was 100K to 500K. So something 75 lakh to 3 crores was my sweet spot. And
And
uh,
this was all like fintech only. The focus was
only fintech.
investment.
That's all I knew. That's all I had studied. That's all I had worked. So I knew that rather than spreading yourself too thin, wanted to have one focus. And I think that was something well appreciated by the family office itself. It was uh, someone who knew what he wanted to do, someone who had a focus that did help, wouldn't lie. And yeah, and so I think that that's how I had my first capital. I was fortunate that a couple of family offices infused large sizes. So in rather than the 1 CR, I'd kept a 1 CR minimum. So 3, 4 family offices infused decent capital, and that gave me the breakthrough I needed for my first close and so on.
Okay. Okay. Interesting. Um, why aren't you still running that fund? Because the fintech space has just become hotter and hotter, and you were an early mover there. You could today be running $100 million fund if you decided to continue that route. So what
No,
changed?
absolutely. In fact, I did have a very good run in with the fund. Um, I had almost 6 exits within the first 11 months, enough to return the entire capital back to all the LPs within 14
Wow,
months.
wow.
But
How many
what
investments did you do in the first year?
we around we had a total of around 50 investments.
And how did you get the exits so fast? Exits take time to mature, right?
Yes. So to give you some, we were literally the first investor in companies like Bharat Pay, uh, Home Capital, Liqui Loans. So what happened was those businesses went through their cycles very quickly, were able to raise substantial capital very early on,
Yeah, Bharati
and
was at one point of time the fastest unicorn, fastest to reach unicorn status in India. Okay. I'm wondering why you didn't hold on to the stake instead of diluting in subsequent rounds. From what I can understand, you must have sold your stake in subsequent rounds. So by Series B, you must have exited most of these investments. Whereas most VCs want to hold till IPO or till the Series E kind of a stage, because the multiples are much larger by that time. So why did you
no, you're
decide
you're
to?
you're, you're spot on. But see, ultimately, we were more of a founder focused fund, that not even a fund, founder focused LLP that we had set up. I knew very well when my learning or my skill set helped the founder go from 0 to 100, but from 100 to 1,000 was the right institutional investor that came in, and that's their help that will come in. By just sticking around on a cap table to optimize your gains, yes, that is obviously a value add, but at some stage I had made up my mind that the true calling was lending. So just to fight and stick around was not something that I always wanted to do. And in fact, very clear that this fund, because most of the LPs were first-time investors in this private space, and they come with a mindset where exit or liquidity is um, the actual your MOIC is not as lucrative as your DPI. So
Wait.
wanted
What
to,
are these terms? MOIC,
sorry.
DPI.
So MOIC basically, sorry, is more like the value or the multiple on paper, and DPI is your actual return when you're running a fund.
What are the full forms?
It's basically your multiple on your invested capital.
MOIC. Okay.
MOIC, multiple of your
Okay.
invested capital. So
Okay.
usually you calculate it. So every fund that usually comes to raise capital, say that my previous fund I had an MOIC of 4x or 5x, but your DPI was
And what is the full form of
DPI.
DPI?
So DPI is it's basically how much capital on your return we have you returned back. So
Okay.
irrespective of the money raised, it's how
Hmm.
much money you've returned back or invested, your money returned back. The capital return back always drove me more than the multiple on paper. So I always wanted to ensure that these investors did get their capital back, and the quicker the exit, the better. More than today, and that time it was still so nascent. This whole space, that fear of your first venture not being successful could also override my thinking at that time. That did cloud my thinking. Where let's not be greedy, Alesh. This is something you've been fortunate. Get an exit, give the return. You will be supremely thankful with this decision, and did play out because most of the LPs wanted to back me in my next venture, right? And
Okay.
maybe yes, I could have returned them with a higher capital. Maybe I could have not even given them any exit after 7 years. So my thinking was only because my first venture, Anish, and focus more on capital return rather than just paper valuations.
Hmm. Okay. Interesting. Interesting. So, yeah, tell me that journey. So, by when did you deploy all the capital that you had raised?
Thought process, Akshay, in probably in a span of 12 to 16 months, the entire capital was deployed.
Okay.
Uh, so it didn't take long to deploy. And in fact, what happened was we did not even end up deploying the whole amount. What had happened was that we ended up deploying only 60% of the raised capital. And so did not
And
even bother with the third tranche of call for money.
okay. Essentially, by that time, you decided to that you don't want to be a early stage
So it's
investor.
not it's not it's not about I decided. That's not what I wanted to be, obviously, uh, because that's doing injustice to the LPs in the fund that had in. So it was never I'd never made up my mind. That's what I want to do. It was just that uh, good exits had come. You have already returned the capital. Do you want to continue doing this? Is the question, and the LPs are more than happy when you tell someone that your third call for money will not be needed. In fact, I'll be returning the capital and above, uh, and I think that was well appreciated.
Hmm. Okay. Okay.
And I think it was also
Interesting.
because of the LPs that were the kind of LPs that were in this fund with me, because they were all family offices and they were not institutional. Maybe an
Hmm.
institution was there, my thought process could have been different. But because it was all family office or prop capital of their families, they just wanted to be pretty safe.
Okay. Okay. So you saw that lending was how every fintech ended up monetizing, be it bookkeeping software or be it like cred, which is supposed to be credit card repayments,
Correct.
or like payment companies like Paytm and RLP. All of them are monetizing through lending. So what was your thesis then?
I think very clear that lending was the true calling, and then lending was a space that was going to grow in India. Credit penetration was going to increase tenfolds. In fact, being someone who, when I was in America, I did get my iPhone on credit, and it was bundled with my service provider back then. And at that time, when you're college, you're working, you end up doing the IRR. But towards my latter stage, when I was just about moving from America to India, I realized for someone like myself who understood the space, was ultimately paying a 30% IRR on my iPhone in America. Um, and that gave me a sense on what was could potentially be the scope in small ticket space in India, uh, and I knew that technology was there to disrupt. That was my strength. Where could you mix technology to improve certain processes in how small ticket loans were happening, and but because of my maybe you could say thought process, day one wanted to be the secured space. did not want to get into an unsecured space. That was just how my DNA was wired. Um, and I think so. What was a product that was high yielding but also a secured space, and technology could help change that. So that three amalgamation of all those 3 points came to two wheelers. Two-wheeler lending was something that uh, was ripe for disruption. It was dominated by incumbents and legacy players for the last 20 years. The same way was happening. You started seeing these shifts in consumer durables. You started seeing the shift in personal loan, but two-wheeler loan had yet to see that. And that's when, after going through almost 3 months of research on grounds, going through dealers, realized the true pain point of that.
What is the pain point?
Um, to answer you, like in a very basic manner, it's like the same customer who's getting a mobile phone, a 50,000 or 60,000 mobile phone in a span of 2 minutes, is having to wait almost 4 hours to 24 hours for the same quantum of capital loan for a two wheeler. Um, and dealers ultimately end up losing the sale because the customer ends up going back home or moves on to a different dealer, and that loss of business was coupled with the fact that uh, the same amount of loan it required us like a physical documentation, physical photograph, physical signing, uh, was extremely difficult for me to comprehend. And second most important for a product like this, where it's small ticket, a lot of incumbents and legacy players had set up branches just for customers to come and check their EMIs, check their statement of account, to come collect an NOC, no objection certificate. So, there were a lot of operational inefficiency in this space, and I knew technology was there to solve it. And that's the challenge which I took up. Could Creditwise Capital challenge these operational inefficiencies?
Okay, interesting. And you're saying the reason for this long approval period is because uh, there was no digital first company in this space. All the companies were legacy companies.
Correct. So
Okay.
two-wheeler is a very unique product because you can make it 94% digital, but there is a leg where that requires an RTO form, your invoice and insurance, which needs a physical leg. The customer needs to sign the RTO form physically, then only his two-wheeler gets registered. But rest, a whole process could be digital. So just because of
Why
that
why are
specific,
why are you involved in that RTO form? Because the
because
form says that this is hypothecated.
this needs to be hypothecation. The hypothecation
Okay.
and the physical form is required at the RTO,
Okay.
without which your car doesn't get registered.
Okay.
So that
And for
because of
people
that
who don't understand,
6%.
hypothecation is essentially a way to
So
tell the world that this is against a loan, that
yes,
this is guarantee against a loan.
hypothecation is a way that makes this product from an unsecured product to a secured product. The bike gets registered or hypothecated to the lender's name, for in our case, Creditwise Capital. So if the customer defaults, we can go collect the vehicle because the two-wheeler is hypothecated to Creditwise Capital. That gives us the allowance to go repossess the bike.
Okay. And once he's paid off the loan, then there is a like a transfer of ownership, or what happens then?
Yes. So that's when the credit-wise capital or the lender, in any case, issues a no objection certificate and the hypothecation gets removed. So post the loan, the customer is free to uh, drive the
Customer
vehicle
needs to go
without
to
any
the
hypothecation.
RTO and do that
Yeah,
removal of.
yeah. He
Okay.
doesn't. He doesn't need to. So for the RTO, for NOC, the customer doesn't need to go to an RTO. For the NOC, the customer just needs to come to his lender and get an NOC from us, and his hypothecation gets removed. It's the lender's job to do it. Most
Okay.
what was happening, most of the guys were doing it at a branch. They would tell the customer, "आप हमारे branch जाओ or go to our branch, and we will issue an NOC there." Where I saw that and I said, could this leg not be digitized? To give you a small example of one of the legs.
Okay. So tell me what you built, like that 0 to 1 journey. Did you first apply for an NBFC license, or did you start by
No,
lending on others' books?
straight away applied for an NBFC license. That gave me time. We were very fortunate. We got the license relatively quick,
How quick?
in about three and a half months.
Wow.
Um, yeah. So I think the fact that so just to give my family background has an NBFC itself, um, which is into loan against shares. I think that coupled with the fact that I had some kind of financial services or financial technology FD fintech experience that did help in fast forwarding the license part. And yeah, and we got the license in three and a half months time, and Jan 2019 is when Creditwise Capital was born.
Okay. And tell me that journey. Like, what did you launch? What did it look like when you launched? In terms of how much had you digitized? What was the customer experience at the time of launch, and how has that evolved?
So we started with Mumbai, just because that was a hometown and home city. So if you feel that's closer to home, so you want to start the business around you so that you can at least have some focus on collection. The first person we hired was our head of collection. He till date continues to be our head of collection. Um, and we said
Did
that
you raise
let's start.
funds initially?
Yes, so very fortunate, Akshay, that three of the individual from my previous venture decided to uh, almost seed this along with me. So I was in this lending business. Raw material is capital. So I was very fortunate that when we started this, we had a decent size, almost 50 crores of equity capital to start off with, and that does make the journey slightly easier, um, because what happens is this business, as you scale, debt becomes a harder challenge to raise the right quality of debt at the right pricing. Having the right set of equity is extremely key. You can start either with a 5 CR or you can start with a 50 CR. 50 CR uh, is pure play, will take you at least way longer, only not just because you have that capital to build tech, but it's just more that capital to help you leverage further. So,
I think typically there's a 1:4 ratio, that for
so,
10 rupees of
so
capital, you can lend 40 rupees.
yes, so NBFCs are allowed to go up to seven, but depends on your risk appetite and how much you value a good night's sleep. For me, that good night's sleep did comes at a level of 3.5.
Okay.
Even though my ROE kicker comes in at a 4.5x leverage, for me 3.5 is the benchmark.
Help me understand what is an ROE kicker.
So your return on equity, the higher levered you are, is when you start benefiting your operating leverage. So when you've reached a decent size, less amount of equity has helped you leverage it further, so that your return on equity is maximum the more levered you are. But the more levered you are, obviously, comes with its own set of risk. And so for me, um, maximum ROE goes to 4.5, 4.6x of your leverage, but
But
whenever
what
it comes close to,
shouldn't it be seven? I mean, if you're allowed seven, then if you go to 1:7, that will
no,
be the
I mean,
maximum ROE.
on theory, seven is would make sense, but as a business, on our business with how we have built it, the amount of people required and additional capital required to continue with that operating expenses, you can't only just keep lending, right? You need some expenses to ensure your day-to-day expenses go. So that's why if I didn't have to pay any salaries or any expenses, then obviously on my equity capital, 7x gives me highest operating leverage. But you need to park some capital to ensure your day-to-day expenses, your other operating expense. So that's why 4.6, 4.5 for a business like mine.
Understood. Okay, okay. Just to kind of simplify this a bit for listeners. So, if you have 10 rupees and you're lending out those 10 rupees, and just as a simplistic example, you earn 10% on that. So you're earning 1 rupee. And so your return on capital is 10%. But if you have that 10 rupees and you borrow 40 rupees, or you borrow 30 rupees more and you're lending out 40 rupees, on that 30 rupees you might pay maybe some 7% interest, but that remaining
Correct.
3% on that 30 rupees, that 9 rupees is your return. So that
Yes.
10 rupee becomes 19 rupees. So now your return on capital is
Much
much
more. 19
higher.
on, yes,
Yeah.
19 on
Yeah.
your 10 rupees.
Right,
Yes.
right, right. Okay, okay. ठीक है. Understood. Okay, got it. So, how much did you dilute for raising 50 CR in your, like, at the very seed level?
So we had a very equal split at that time, where I would be the one I would be the one driving it. But this business, Akshay, the slight complexity was this business requires personal guarantee, okay, to raise debt capital. Having had that experience with a family business, knowing that at my net worth, there would be a ceiling at which how much I would be able to raise debt. So to get the right set of investors also at an early stage was very very key. Where you come in, equity is equal, but you get all four of them to give you personal guarantee. All four of you guys to give personal guarantee, and that catapults you to a very different level, because uh, nobody is going today in today's day and scenario. Uh, you're not going to get debt without giving a personal guarantee, very honestly. And today, likes of massive NBFCs also that have already reached unicorn status, the founders and the founding team still continue to give personal guarantee. So that's a
Interesting. I
very,
was not
very
aware of that.
niche, yeah, niche understanding or learning that NBFC ensure that you are around the right people that are able to give personal guarantee. That will allow you to scale much more and give you the right pricing for your term loans.
Interesting. So there's no way the other three investors would have agreed for personal guarantee unless they have enough of a stake in it.
Fair
So
enough. Uh,
yeah,
because
yeah, yeah, yeah,
there's
absolutely.
nothing that shouts out skin in the game as much as personal guarantee. So that is
Right,
extremely
right.
key.
Okay, okay, okay. Understood. Interesting. So okay, you
And
raised
but
50
also
CR.
just yeah, but from day one realized that while this business technology is key, technology will continue to play the role of a value enabler and not a value creator. In this business, experience, or the first word you mentioned, the gray hair, continues to play value creation role. uh, and it couldn't be more emphasized enough that uh, experience will supersede almost everything, but technology mixed with experience is the right formula you need, because you can't have two experienced people building this, and you surely can't have, because you're just one of the other NBFCs, but you surely cannot have two tech individuals building this, because that know-how, that knowing of multiple cycles is it just only comes with experience. So
Okay.
we very early on onboarded uh, one of the most senior members from the industry. Um, he comes from almost 20 years of two-wheeler and commercial vehicle lending experience from HDFC, along with 10 years with HDB Financial.
Okay.
Uh,
Yeah, experience on
so
which side? Like sourcing, loan sourcing, or collections, or underwriting, or
Yeah, so so this person, Gurpreet, who held a senior position. So he has overseen multiple functions from originating to credit to collection to risk. So he came on board, and after almost 1 year of from 2019 2020 is when we built ourselves, and he came on board in 2020, and since then we've been building this together.
he's come on board like a COO or a CBO, something
So,
like that.
so he came. In fact, he came on board as a COO, and over the last 4 years, in fact, he's graduated to become a co-founder level.
Okay, amazing, amazing. Okay, amazing. So, what did you launch with? You had money in the bank, which would allow you to get leverage.
Correct.
Tell me the journey of. You also told me you hired someone for collections. What about underwriting?
We had someone for underwriting as well, but very clear that uh, uh, tech will help me at origination underwriting. So the focus was more on using technology for uh, these two aspects and not collection. I know I don't know if most of your listeners or you would agree with this, but I have a very strong belief that in India, unfortunately, you cannot digitize collection. You can digitize everything. I know there have been a lot of startups that have come to uh, saying that we have digitized collection, but my experience, a lot of my team's experience, that's one thing that has just not clicked, and that was the focus from day one because I saw this cycle with these fintechs in from 2017 to 2019. That was just not happening. So yeah, we started using technology to improve origination, improve underwriting, and we started with Mumbai. Um, very early learned our cycles, and Mumbai is not the right market. It's a rented market,
Okay.
rented accommodation is what I meant. So there are two major aspects in Mumbai. It's broker driven. Okay. Uh, broker is basically small shops that have just spin off from the authorized dealer. They have one Honda Activa, one Hero bike, and they open a small shop and they start financing from there. So some city like Mumbai or any tier one city in India which is high rental yields, it's difficult to have authorized dealers, so small brokers open up, and most of your sales happen from brokers. Brokers are not the most ethical. Uh, Second, they do not have a lot to lose because they do not have an official license from the OEM. And So these cities are dominated by brokers. And if you do your business via brokers, you are bound to fail. And so that we had our learnings, we had our uh, learning curves very early on. Very fortunate because we had not dispersed a lot before COVID came in. So when COVID came in, uh, we had time to go back to the drawing board, figure out a strategy whether we want to be a tier one focus player or whether we can penetrate more into tier two and tier three, and is our tech capable of doing that? So that was our
When you
initial, I would say, 12 to 18 months.
when you launched, were you able to hit that 2 minute approval that you wanted, like the iPhone experience,
So
buying an iPhone on
day
EMI, equivalent to that?
from day one, Akshay, our experience was very good. We were able to underwrite customers in 2 minutes. We were able to underwrite the delta between our underwriting versus underwriting of other financiers in the market was so significant. We had dealers calling us from all parts of the country asking us when is CreditWise going to come live to their city.
Wow.
So we knew we were onto something good. Uh,
And how were you acquiring loans? What was the loan sourcing? The dealer or the bike showroom, they would become your sourcing
yes,
agents.
we had.
Okay.
So what we did, we initially actually started with having people at every dealership, just like the other financiers. So our right to win initially was just a quick turnaround time. Uh, just that was just to get your business started, get your loan book off the ground. But I, from day one, Akshay, what troubled me was couldn't believe that there were 5 to 6 individuals at every dealership from different financiers just sitting there playing PUBG, waiting for a customer to walk in, and the dealer gives them a loan. It was like more like a round robin system. I there are 30,000 dealers across the country today disbursing almost 18 to 20 lakh two wheelers. It's impossible to have 30,000 people uh, on your roll. You cannot be. So that was a heavy people intensive business. Okay, and day one wanted to change that, scale up that aspect. But initially, obviously, wanted to build my AUM, get it started. So from the 12th month onwards, or 15th month onwards, what we started building is one of the most unique things the two-wheeler industry had seen. We have a QR code. There is a 6 foot standee that holds a placard that says scan this QR code and get your loan approved in 2 minutes. As soon as the customer scans it, it redirects him to WhatsApp. Now, WhatsApp is the most used medium in the country. Nobody taught us how to use it. We learned it by ourselves. The customer scans, redirects him to WhatsApp. He chats with our WhatsApp bot. We integrated all the underwriting tools, all the disbursement capability, all the legality, e-sign agreements on WhatsApp itself. So what we did in effect is build an end-to-end loan journey on WhatsApp. My manpower doesn't have to be at the dealership. The customer comes, the dealer tells him scan this QR code, check your eligibility, and the dealer gets a loan. And that completely revolutionized the whole two-wheeler lending space because we were in fact the first uh, lender today who's doing this without a manpower. And that was our I would say the second phase of our right to win. First was the TAT, second was more manpower. So these two processes helped us scale significantly. Let's say from like 2021, my AUM was 50 crores, and today I mean, by 2024 last year we were at 500 crores. So in 3 years, scaling 10x, I think, and that itself was a testament because dealers started liking you. You are approving it quickly. Customers started liking you because you have to take your own time, speed, uh, do it yourself, and not somebody telling you what to do, what not to do. And that helped us catapult us to the next phase of our journey.
Amazing. Um, how would the dealer get paid if he's directly scanning a QR code? Like if, every QR code has some location tagging to it, so that you know
Every every
which
dealer has its
dealership.
own unique QR code,
Okay.
uh, and so he doesn't have to. He just has to ask the customer to scan it. So if it's scanned from his unique QR code, the disbursement happens too.
Okay. And how much does the dealer earn when you disperse, let's say, a 50,000 rupee loan?
On an average, dealer payouts in the industry range from 3 to 6%. Our average dealer payout is 1.4%.
Wow. How is that?
So that came to our third phase, Akshay. We knew that so that turnaround time we were pretty good. We were doing 2 minutes. We also knew that tomorrow there could be this is not a long term mode. Some stage or the other, someone will do it in 60 seconds. Okay.
Yeah. Yeah.
Second,
Yeah.
so so that couldn't be a long term one. Second phase was the whole QR code mechanism, but we were facing some challenges in your tier two, tier three region. Okay, the whole WhatsApp journey. So phase three
What kind of
came in
challenges?
regional languages, and
Okay, because your bot would be talking in English. And
English. So obviously we built regional language, but these are those customers that might be a little wary of doing the journey themselves. They need some assistance. So we
right,
face some
right, right.
challenges in that aspect in tier two, tier three because our overall vision actually was to focus more on tier two, tier three and move away from tier one. So so phase two had its own challenges and came phase three, which obviously was the biggest moat that we have till date is we tie up with fintechs. Okay. Now let's say, for example, a Bharat Pay. A Bharat Pay has millions of merchants on its platform, right? They don't want to get into two wheeler financing, but their customers have a strong affinity towards two wheelers. So on the merchant app, you'll see a banner that says scan this QR code and get your dream two wheeler bike. The merchant clicks that, it redirects him to my WhatsApp chat. He chats with the bot. He says, I want a Honda Activa. My bot tells him, please take this sanction letter and please go to Ariant Honda based on your location with the sanction letter. So this merchant walks into Ariant Honda and says, मुझे credit wise capital से कुछ loan मिला है. Now, I have originated business for Ariant Honda here. And my only thing to this dealer is I will not charge you for this, but you will prefer me over the other financiers who are paying you high payouts. And that is the biggest moat that we have created because unlike anybody else, we are originating business for dealers. And that's adding to their revenue.
Amazing, amazing. And the economics of this would work like this, my assumption that the 3 to 6% which normally you would be giving to the dealer, instead of that you're giving 1.5%, and you're also able to give Bharat Pay another 1.5 to 3%, so that
Not
it's
even
a
not
win-win for.
so the thing is with these merchants, it's on disbursement. There is no OPEX there. For most of these players, it's about showing some kind of revenue from their acquired customers. Uh, for them, the payout doesn't range anywhere even close to this 1.5 to 3% you said. It's in fact is less than 0.2, 0.3% because of the sheer volume that they have on the platform. So,
Uh, Bharatpay will get paid per
per
disbursement
disbursement,
or per lead?
per
Okay.
disbursement, per disbursement.
Wow. And that amount is just 0.2%.
Correct.
Amazing. Amazing. Incredible. I think, someone from Bharatpay who watches this podcast might come to you and renegotiate. Okay.
Fair enough.
Okay. All right. Cool. Okay. Amazing. Amazing. So, therefore, your lock on the dealer is pretty strong because you are not another financier, but you're also a lead generation partner for him.
Correct. Correct.
Okay. Amazing. Amazing. Okay. Um, so what all do you do today? So one is you do this lead
Perfect.
generation for the dealer. Second is on the dealer location, you have the QR code through which his walk-in customers can get a loan in 2 minutes.
Perfect. Now, actually, 55% of my customers are new to credit. They are literally, when I say new to credit for the listeners, it's first time borrowers. They are first time taking any product on financing. In India, in tier 2, tier 3, it's roti, kapda, makan, and gadi. Two-wheeler is like a lifeline. Okay, it's your
Yeah.
fourth basic necessity. So everybody, because of a lack of Uber, Olas in that place, lack of buses, to go from your field to your house, you need a two-wheeler. So 55% of my customers are new to credit. We are formally bringing them into the credit system. Now it allows me a huge opportunity to cross-sell. Same customer, I will be giving him motor insurance. Same customer, I will be giving him health insurance. Same customer, I will be giving him roadside assistance. Same customer, I will be giving him like OPD or hospi cash. Okay. Now we know that today you can get your 2-3% ROA in lending, return on asset, in lending, but taking it to the golden standard of like a 6-7% things what HDFC has does now. In HDFC you open your current account. First thing they will be like, we'll sell you credit card, take our uh, 3-4 other products they'll sell you, right?
Yeah. Pre-approved loan
Exactly
and
wanted.
yeah.
That's exactly wanted who we wanted as a North Star. That's exactly how we wanted to build. You cross sell becomes so integral that it straight away hits your bottom line. So that becomes the second aspect of what we do. So there are three major verticals: retail lending, which we spoke about. We started with two-wheeler financing. Second aspect gets into cross sell. We cross sell products on where we tie up with insurance companies. What we also cross sell is via an aggregator model. Um, Now, Akshay is a two-wheeler customer from CreditWise Capital, but Akshay also wants a 1 lakh personal loan. He comes on the CreditWise Capital customer app and applies for a personal loan, but I have tied up with AU Bank and Yes Bank on the back end. So you get a personal loan from these channels, and I just get my fee income. Akshay wants a credit card. My customers have a huge affinity towards credit card because it's a status symbol in these regions.
Yes.
So you
Yes.
want the
Yes.
credit card, you will get it via the CreditWise Capital app. But in the back end, I have tied up with RBL, I have tied up with Yes Bank. So there are two ways of cross sell. One is insurance on by myself. Second is an as an aggregator. So that becomes part of my second vertical. Now, third major vertical, Akshay, is technology. We have a subsidiary under CreditWise Capital whose core focus is to build. So what happened is a lot of NBFCs and banks that came and evaluated us from a debt perspective would look at our system and be like, could you build the same system for us for our other products? So we saw that as an
And
opportunity.
what is this system? What all does it do?
So our LOS, we have two products.
Loan origination system.
Loan originating system. One is an easy
Okay.
lending product, which is the loan originating process, and the other product is called easy payout, which is more of a channel management. So when you onboard a dealer, when you onboard a DSA, their payout calculation, scheme calculation, that entire thing needs to be digitized. You would be very surprised, Akshay. Today, big banks, NBFCs have a team of 30, 40 people manually calculating payouts on Excel, manually calculating schemes. So, to digitize that process, we have these two products. So banks and NBFCs, when they came and saw our system, they said, could we have the same two products? So that gave an opportunity that maybe Alish, you've spent so much time building these kind of systems. Could you not monetize it? For products apart from two-wheeler or any product that CreditWise Capital wants to be in. That gave rise to the opportunity, and the subsidiary under CreditWise Capital today has clients like DCB Bank, Muthoot Capital, Karnataka Bank, and the large institutes. We focus on the short tail rather than the long tail, and we've had almost 26 such clients that are using our products from the tech subsidiary.
Amazing. Um, I want to understand the kind of revenue and margin profile for these three businesses. So, uh, you have the retail lending business, so which you said is giving you about 3% return on capital employed.
Correct.
Okay.
Correct.
Uh,
So I'll tell you, you lend at anywhere between 21, 22%. In the retail lending, your cost of fund ranges from 11 to 12%. Um, your OPEX initially is at the higher end, it's around 9.5%. Your credit cost is around 2%. So your pre-tax ROA is around 3.5%.
and
Uh,
OPEX includes what?
OPEX
What does
includes your tech
OPEX?
expense, your tech team, your
Okay.
collection team, your that 1.5% of dealer payout, every single expense. Okay.
Okay. Okay. And credit cost is the NPA cost, basically.
NPAs, credit cost is
Okay.
NPAs.
Okay.
So you are at a pre-tax ROA of anywhere between 3.5%. You add cross-sell business. Cross-sell business, you earn anywhere between 3 to 4% on additional of this 21%, with a heavy margin of around 35-40%.
So
So
you're saying 3 to 4% is the on the transaction value. Like if somebody
correct.
buys insurance of 100 rupees, you get 3 4 rupees in that.
No, no. So what I when I say that, it's mainly like, suppose your fee income part. So today, if you are making 21% IRR, you add additional 3 to 4% on that. So your blended IRR comes to you earning 24-25%. That's the 3-4% I'm saying. In
Okay.
To answer your question, if I'm uh, cross selling someone worth products of 100 rupees, my margin there is between 30-40 rupees, not 3-4 rupees. 30-40% is my margin in cross sell.
Financial products don't have that kind of margin. If you're selling insurance,
No, so
it
in
doesn't
fact,
have.
the kind of insurance products we finance, Akshay, are something like a loan protect insurance. So suppose uh, tomorrow you've taken a loan, and for whatever reason something happens to you, your family is not burdened with the loan. So products such as this, then roadside assistance. These kind of products are slightly heavier on the margin side. The products that you are talking about is more on the motor insurance piece, which I completely agree. Those margins are slightly on the lower side, but our core focus is on loan protect insurance.
Okay. Why not do as much as you can? Like, why not also do motor insurance? Why not also do life insurance?
We
Why not
do
also do
motor
mutual
insurance,
fund?
but what happens here is, the dealer wants the motor insurance done at his dealership. The dealer wants the
Okay.
motor
He earns
insurance.
a right.
He earns a
Right.
cut there. So what we do is, first year motor insurance is done by the dealer. The 11th month onwards, we reach out to our customers and we renew it from our side.
Okay. 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 And what about other products like, say, investments, saving products, digital gold?
Yes, so we have an opportunity, because being in the fintech ecosystem, we have an opportunity today to cross sell multiple products. But what happens is, ultimately, I don't want to uh, over lever this customer, because ultimately it'll impact my credit cost. If I tell this customer that he has five other EMIs he can take from CreditWise Capital, will he pay the two-wheeler EMI? It becomes a question mark.
No, but
So
you
that's
could, like, digital gold is like an easy sell, right? People from tier two, tier three typically see gold as the way to save. That
correct.
could be an easy sell.
Correct. But we so very different thought process there, because in India, the customer that takes gold finances, gold loan is usually a stressed customer. Unless the South, if you've taken a gold
You're
loan,
saying gold loan or
that's a
loan
last
against
resort.
gold?
Loan against gold.
Okay. No, I'm saying that investment in gold, like digital
Yeah,
gold, buying that
correct.
kind of savings
Correct.
product.
So things like, see, we were very clear that have like a focus where just cross sell things that are very doable. Like you tell this customer that start investing in gold. This customer mindset is very different. He requires only things that are around him tangible. He anyways his average salary is between 20 to 30,000. Doesn't have that much capability to invest in other savings product, investment products because he lives month to month. Okay, so maybe probably as we go towards come have more of a tier one uh, customer base, maybe we could introduce these products. But right now, because it's tier two, tier three, very clear that help this customer with his requirements. That is a must rather than bombarding him with multiple other products.
So you would rather focus on going deep rather than going wide. Like instead of
Yes,
offering
yes,
100 products, you would rather do a few products
yes,
but penetrate deeply those
yes,
categories.
absolutely.
Okay, interesting, interesting. Okay,
And the
okay.
tech vertical, we have two streams of revenue. One is an enterprise model, and other is obviously SaaS model, where it's per approval, per login that we charge most of these clients. So that itself is uh, good business, profitable. All three verticals are profit centers. All three businesses are PAT positive. So that's the mindset that whatever it is that you're building, Akshay, especially in lending, if you are burning, you're doing something wrong. I know a lot of your listeners who are building something in lending might uh, not be very uh, happy to hear this, but that's just a genuine thing that if you're burning in lending, you're doing something wrong. Maybe reduce the tech expense or whatever it is that you have to do, but just you cannot be burning. That's the cardinal rule. And that's something we've stuck with from day one at CreditWise Capital. So, and it's helped us today scale to this level, have the right tech partners. We are, in fact, the first and only co-lending partner of HDFC Bank. And HDFC Bank coming and giving their sign of approval on our credit, on our underwriting, on our technology. I think that itself was a major victory.
How does co-lending work?
So co-lending is works in two models. One is real-time disbursement, where the customer on ground, 80% is given by the co-lending partner, 20% is given by the other side of partner, for in this case CreditWise Capital. And the 80%, there is a fixed hurdle rate that you pay the hurdle rate, and anything on top stays with CreditWise Capital. So it's less capital deployed from CreditWise Capital's perspective, but you are earning on that 20% gap also the whole of 20% that you've lent. So that's how
Okay,
co-lending works.
it's
And
a way to increase your lever, basically. Your
yes, absolutely
amazing without having it on your books, but you
correct,
continue to
correct,
earn a return on that.
correct.
Interesting. Okay, okay. But the amount you earn from a co-lending versus borrowing on your books and then lending, what is the difference in that?
No, so if you look at an ROE perspective, co-lending goes almost 3x the time of your normal on-book lending. You earn on an ROE level, you earn more. But what happens is uh, co-lending. Uh, So prior to the FLDG guidelines was almost like a risk-free for the regular for the co-lending partner. So for them it was no risk sharing. You have to give a collateral. You have to give some kind of cash deposit, and as soon as a case goes into like even a second bucket of delinquency, you have to buy it back on your book and give them a fresh case. So it was uh, high delinquent but high yielding also. But with the new guidelines coming in, I think that itself has been cleared out. So you can't have a max. You can have a max FLDG amount. So
I
co-lending
think
does
five
becomes
percent is the maximum,
five
or how
percent.
much is?
5% is
Okay.
the maximum on digital lending. But that makes your cold lending book slightly more lucrative. But ultimately, it's looked also in a manner that what's their skin in the game if they are doing a whole thing on cold lending as well. So you have to find that right blend that works for your business. For us, it's 70% on book and 30% cold lending, and that's the ratio we always want to continue building in. But you have to find the right mix that works for your business.
What is the interest margin on the co-lending loan? Like if
So, so because the scale that we have achieved, we've managed to get our co-lending prices equal to our term loan prices. So you, in fact, you as a business today, uh, our
by
cost of
price you mean your interest costs, like what
interest cost.
you borrow. If
Yes,
you borrow 10%, so you're saying even in co-lending your
co-lending.
hurdle rate is
We
10.
managed to get it at 10%, but others today,
Wow.
co-lending will be slightly higher.
Hmm. Amazing, amazing, amazing. Okay, that's phenomenal. What ARR are you at right now, or what ARR will you end this year at?
So we will be at 15 million ARR
Hmm.
and
By
almost.
end of current financial year.
Yes. Yes.
Amazing. Yeah, this is the gross revenue basically.
Yes. And for us,
Okay.
there are only two revenues: interest income and fee income.
Hmm.
So that's the
15
only
million.
revenue.
Amazing.
For us,
Phenomenal.
we don't have things like GMV or any of that. We just have pure
Right.
play revenue.
Amazing. Amazing. That's phenomenal. And what will be your loan book size by the end of this financial
We
year?
will be at around 550 crores. That'll be a
Okay.
loan book.
Amazing. Phenomenal. So,
We
what's
would have
the way
disbursed
forward?
over we would have disbursed over 1,000 crores, and loan book will be 550 crores. We would be having almost 1.5 lakh customers. We are present in 10 states today, almost 150 cities, but completely branchless. The office that I'm speaking in to you is our only office in Bombay and in Pan India. We don't have a single branch anywhere else, even though we are in remote locations in Bihar, Jharkhand, Odisha. Everything is done without in a without in a branchless model.
What does
And
your organization
answering
look like? Like how many people doing what? How many people do
Yeah, so
collections?
we
How many
have
do dealers?
majority of the bulk is collection and sales team. A total collection, a total of team organization strength would be around 400 people. I would say 80% of that is your sales and collection team. Um, the rest of the team is tech, product, and senior level management team. We've tried to
How many
digitize
in
most
sales
of
and
the
how many in collection? Like equal split or?
collect, collection, and yeah, would be equal split.
Okay. 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 All right. Uh,
You'll be having over 500 dealers that you work with, but you'll be having around 150 sales teams. So we've tried to remove the whole one person per dealership model because of the QR
ama-
code coming.
amazing. Amazing. How do you manage these salespeople remotely?
So we how we've managed is uh, we have a business head. Business head has a state head, so there is a proper hierarchy. Management happens via a sales app, where it's pretty in depth. A sales app where your dealer conversations happen via that. Your targets for the day happen there. Your cross sell management happens there. I and Gurpreet sitting in the office in the cabin have live updates on what's happening via each state. So I think what we have done is go very deep in a granular level, um, and tried eliminate. See, what we wanted to eliminate was the state head or the sales business head calling everyone conference call. आज कितना business होने वाला है. We wanted to eliminate that, and that's exactly what happens today, right?
Hmm.
99.9 lending companies, that's how it's been happening. So we wanted to eliminate that. Can you better utilize this guy's effort and time in some way where tech can help you? Everything that we build, Akshay, in is CWC's tech for a purpose to help reduce the operational efficiency. There is nothing that you will see where we've just built a jazzy platform or and focusing on SEO, SEM, because two-wheeler is a touch and feel product. You're going to go with a Nariyal, you're going to go with your family to break the thing. So you're not going to it's not going to happen online. So don't spend time on that. Don't spend effort on that. So That's the DNA at CWC, where just improve operational efficiency using technology.
Amazing, amazing. And what's the roadmap for the next couple of years? Where do you see this going in terms of categories you are in, the kind of AUM
For
you'll
us,
have, the
for
revenue
us,
split?
by 27, 28, we want to reach a 3,000 crore AUM from just purely two wheelers. But we have seen we have seen that journey where cycle customers move to two-wheeler customers over the last 15, 20 years. Can these same customers of two-wheeler move towards a used car? Right? Okay. India's growth coming up, aspirational product being a used car. Can the same customer move towards that used car? Uh, so obviously, way forward will be to add just a couple of products in our journey, with two-wheeler being the backbone. What how we will build is use that existing customer base to try and figure out a way to leverage that and add more products along the journey. And collection first approach will be with any product we start. So 3,000 crore AUM by 27, 28 is the vision. For us, North Star would be the likes of an AU Bank or like an SK Finance that started with one product and added multiple products along the journey. Unlike a fintech that has been able to scale in 12 to 18 months. So
Okay.
that give you help you answer who my North Star would be, given you a name, and who my North Star wouldn't be, is we all can take a vote.
Okay, okay, amazing. Um, how does you told me one role of tech is in terms of this managing your sales force. Another role of tech is managing the customer journey. What are the other ways in which you're using tech?
Um,
Does it
say
help you
for
in
example,
collections, in underwriting?
so what we've done, yeah. See, what we did is collect tech we've used to our customer base. Now, Akshay every month pays his EMI only via a physical outreach, but XYZ customer always makes the payment via a WhatsApp reminder. Now, 99.9 NBFCs, they just send this entire customer base to collection agencies. Now, can you not, using machine learning, figure out how Akshay's paying pattern is, how Aalesh is paying pattern is? Don't no need to send the whole thing to the collection agency where you will be paying a payout for Aalesh who was anyways paying via WhatsApp reminder. Now that reduced our collection agency expense drastically.
When does the collection agency come in? Like beyond a certain days of delinquency?
So, second of the month is our presentation date. So, any customer, when we register their e-Natch or UPI, second of the month we hit the bank account. If you have not paid, you're a bounce customer. So, you can expect anywhere between 15 to 18% of the customer bounce. Then, what we have done is there is IVR calling from the second of the month to seventh of the month, saying that we are again going to represent. Please ensure there is money in your bank account this time. We do a second presentation on the 7th of the month. If you still bounce, 8th of the month to the 14th of the month, there is Zoom in telecalling. Uh, please ensure there is, please pay. We are sending, go via the app or this is the link, please pay. If Akshay still doesn't end up paying, 15th of the month, it's straight away passed on to the field team. From the 15th to the 30th, the field team comes and collects the EMI. If Akshay is still not able to pay the EMI, then the field team then just repos the vehicle and parks it at a yard. So that's the end-to-end collection journey.
And the agency comes in when it's the field team
Correct,
time.
correct. The repo. So what we do, we try to keep the earlier buckets. When I say buckets, earlier allocation customers that have just missed one EMI or two EMIs with in-house. When it's the later stage customer, those notorious customers that have just not made any payments for like 6, 7 months, we may keep that more from an agency uh, mindset because they have a different breed of how to collect repossessed vehicles and how to collect with that kind of a customer.
I've spoken to a bunch of founders who are building tech for collections. This seems to be a big area. Are you using any platforms for that?
So we have, let's say, we have tried with most of them, but our learning is for a product like ours. doesn't is not the right fit because a small ticket loan um, collection has to be very granular. Each location, you need to have that right know-how, right expertise, rather than just doing it digitally. Your Bihar customer or a Jharkhand customer or a UP customer is not going to make a payment on the phone. Um, uh, but if you go to his house where he's living in a joint family with 10, 12 people, he's more likely to make the payment. So we've had that right set of experience in the team, knowing when to do digital collection, when to do in-house collection. So we've had that learning, we've had that experience. So while it's great for most of the other products, we feel because of our size and scale, want to build this ourselves. Once we reach a certain scale and limit, maybe is when other collection agencies or these partners take us seriously because there is more cases and there is volume for them to work on. Right now, a collection tech partner is more keen to impress an ICICI than impress a credit price
Yes.
cap.
Right.
So they will
Right.
never take my collection seriously. So it's about getting to that scale and size.
Okay. Interesting. Interesting. And what about underwriting? Do you use tech over there?
Absolutely. That's probably one of the strongest centers because we've used tech to the core. We use account aggregator. We use a lot of tools to come up with a underwriting system, underwriting decision. In probably we have 211 checkpoints that we do in real time. So
How do you get 211 data points about a customer? You'd probably only ask him for Aadhaar and PAN, right?
the customer comes with Aadhaar and PAN. That's it.
Right.
Aadhaar,
Then
he
how do
wants
you get
Aadhaar.
the
So, for example, we ask for an OTP. OTP gives me where
phone
with
number?
a ping to the mobile operator. What kind of SIM card uh, he has? Is he a Geo customer or a Vodafone customer? That helps me bucket wise your customer straight away there. Is he prepaid or
Interesting.
postpaid? That helps me categorize you even further. When was your SIM activated, Akshay? If your SIM was activated 15 days ago, hell no, you're not getting a loan. If a SIM
Okay.
card, if a SIM card was activated 5 years ago, at least you're a stable customer. So things like that. Just the list goes on and on.
A lot of fintechs use device analytics, like they make you download an app, and then that app can read your
Yeah,
device data, like which phone are you using and what all apps do you have on your phone. But you're
we
going through a
don't do
WhatsApp
that at
journey,
all.
so
Yes, so we don't have that
aren't you
at
missing
all.
out on data which would
No,
help you
so
make better decisions?
uh, one, but we have. So I'll tell you. I'm sure that these guys are doing it in the most efficient manner. But we were very fortunate that on our board we had people from RBI and SBI uh, there on our board from day one itself. Very against the whole data scraping, SMS reading, app scraping. So we never had even the opportunity or mindset to get the customer to download an app. Telling my customer to download an app for another loan product is going to be a challenge because he anyway struggling for space on his phone. So we didn't want to go that route. And ultimately, at least in the two-wheeler lending space, if you are able to figure out his bank account, if you're able to figure out his stability, and you figure out his contactability, that's enough. I would say 80% of the battle, rather than figuring out whether he has a Facebook app or a Snapchat app and help use that tool to come up with a decision.
Okay. Yeah, yeah, absolutely. The most important thing for you is income proof, right? You need to know how
Correct.
much he earns.
Correct.
How do you get income data?
Account aggregator. I think that's probably one of the best tools that are out there. Where
How does account aggregator work? Through the
so
Aadhaar, you get
customer
to know
has
what accounts he
no
has.
customer has to input as soon as he inputs his number or then an OTP goes out. The customer then has gets an option. All the numbers that are linked, all the bank accounts that are linked with this number, we get access to that.
Okay.
What is the current bank balance? What is the average quarterly balance? What are his EMI payments? All of that analysis happens via account aggregator. We get he has to allow the bank to give us access. So he does that via an
And he
OTP.
doesn't need to do bank by bank. He'll give you one
No,
OTP, which will give
one
you
OTP
access
and
to all his
two
bank
OTPs,
accounts.
one OTP to initiate the process and one OTP that he authorizes the bank to give us his data.
Okay, amazing. And account aggregator works in 100% cases, or what is the
So
efficacy of?
there are certain so it works with the banks we are present in, but there are certain cases like for example in like your cooperative banks or regional banks, so there are some challenges there. Yeah, obviously it's an evolving process. I'm sure over time that will improve, but 60% of my customers use SBI, and SBI is live on account aggregator. So for me, that gives me a tremendous comfort.
And what is your approval rate out of 100 people
Approval
who
rate
apply for a loan?
approval rate is 60%, and disbursal rate is 50%.
Why the difference? I
So
thought approved would mean unless they decide
no,
not to
yeah.
take a
So a
loan.
lot
Or,
of times what happens is, okay, I've been approved for a loan, uh, but I want a lower IRR. I want a lower rate. I want
okay.
more LTV. Give me 95% LTV. So,
LTV
or
is
okay,
loan
no,
to value, like
loan to value. So
percentage.
like I want 95,000 instead of 1 lakh on road price. If we've approved him for 90,000, but he wants 95,000. Uh, or just something as basic as, okay, I will come back later. I'm approved, but I don't want the two-wheeler today. So there's always a drop off. It ranges between 7 to 8%.
Okay, okay, understood. And somebody for whom account aggregator is not working, do they typically end up being approved for a loan, or?
No, so then we have other checks. So for example, we ask the customer to you put his consumer ID for his electricity bill. Uh, then with the consumer ID, we can ping and the electricity board and figure out his electricity bills, and that way we can get a stability on his address. Things so everywhere there is some. So every time either one of the processes fail, there is a backup ready.
Hmm. Okay, okay. And do you also ask them to upload PDF of bank statements and all? But
Zero,
that doesn't work, right?
zero,
Because
zero,
there's
zero.
very susceptible to fraud. And,
Correct.
okay, okay, interesting. Okay, what other ways are you using tech?
I have almost 500 dealers. We have a dealer scorecard where again um, ML2 bucket each dealer, which dealer is an A plus dealer, which dealer is a C category dealer based on his past trends, how much bounce, what is his delinquency, is he on time with his documents that he uh, is uploading. So uh, we use that to have a dealer scorecard. We've tied up with uh, a partner to help us with a thing called affluence score, satellite imagery to figure out how far or how your customer lives from sc- a school, place of worship, hospital, or a bus stand. Now, this gives me the data, but I've added the whole bus stand piece. Why? Because I know that if this customer is living far away from a bus stand, my collection guy is not going to go to his house. When he reaches that town, he's not going to go far away from a bus stand. So that gives me my geofencing, things like that, right? Because 211 checkpoints, me and you could be probably speaking for the next 3 hours and we still not cover the entire tech stack.
Amazing, 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 awesome, cool. Are you largely doing the ICE engines, like the regular petrol
Yes,
bikes, or are you
yes.
also
We
doing
have
EV?
So, see, 98% of our book is ICE engine, 2% is EV. Very, very cautious with the whole EV thing. We are waiting for it to play out because this is typically what will make our product from a secure product to an unsecured product because there is no resale value of an EV. Uh, your 1 lakh, 1.5 lakh EV without the battery, the resale is 7 to 8,000 rupees. Okay.
Wow.
Uh,
Okay.
yeah. So we only work with those OEMs, Akshay, that have an FLTG agreement with us that we will repossess the vehicle and they will buy it back to us at 100% POS. So, uh, unlike most of the, and that comes with experience, and that comes with Goodreads experience. So that allows us to be core focused that don't. let the EV resale market get well established. Let the at least infrastructure play in, because the segments we are in, customers don't have money for electricity enough to last them 24 hours at their home. Now, if you tell this customer that you're going to be using like EV to charge your bike, it's not going to work. So we are waiting for that whole infra play to kick in, and that's when you will be aggressive in EV. But right now, it's only with those OEMs that have a 100% buyback agreement with us.
Interesting, interesting. Okay, amazing, cool. My last question to you: what's your advice to young aspiring founders? Things you wish you had gotten as advice?
I did. I was very fortunate to be surrounded with the right set of people from a very early stage of my career. So I did get a lot of good advice. I would say just filter out the advice, that works for you. Uh,
Yeah.
and I can't stress on the importance of having the right board. Okay. Um, I know this might be again something very unfounder friendly thing that I'm saying, but um I started off also with what's the need for so many board meetings, unable to understand uh, uh, certain things don't go your way. But it's I think the biggest piece of advice is I wish I got like this board much earlier, or any board, like let's say people who have seen scale size much earlier. And corporate governance is key. uh, End up doing half the revenue, but use that money or saving and investing in the right set of an auditor. uh, that will just help you go for the long thing. The ecosystem around us is gearing up for a marathon rather than a sprint. So be ready for a marathon rather than uh, a 100-meter dash. And I think that's one thing. So it comes down to each founder's mentality. And if things, if you're like, and I had this learning from my boss in when I was working in private equity, that if someone is saying no to you, you're probably in the wrong room. All you have to do is find that one yes. And I think that
Yeah.
itself stuck around with me, where even when I had a lot of no's when I was raising capital from my fund, to a lot of times while building credit wise capital. So just try to find the right room. And that's probably my 2 cents.
Amazing, amazing. Both these are very unique set of advices. I want to go a little bit deeper on the board piece. There is a cost of having a board, right? Because you need to pay them some compensation for getting on your
Correct.
board. And of course, there's a time cost that, like you said,
Correct.
meetings and so on. But so, what's the right stage at which you should be willing to bear that kind of cost of having a board?
I think it depends on so it depends on you personally as to figure out your skill set and try to find a boat that complements your skill set. You can't be a master of all trades, well, especially when you're building early stage. Like my strength was technology and finance. So the board which I did get was focusing more on experience, getting focused more on corporate governance. Um, uh, have Once you figure that out, earlier the better. Um, Also, be selective in the board. There will be 1 out of 100 that will add value. 99 will be there just to uh, collect the sitting fee and give you that, for the lack of word, the right gyan. Uh, so, so just find the right team and be open to uh, criticism at an early stage. And that guidance with someone who has seen scale and size, if you haven't seen yourself, becomes very very key. So it's not about, yeah, it is expensive, but as I rightly mentioned, if you're not able to double your profits or double your revenue, invest in this irrespective, and over time you will be able to get there. I would say timing wise, the earlier the better, in short. uh, like if you have like certain capital that you have raised and you can deploy that capital, can I get a expensive product head versus can I get a senior product manager but deploy this capital from someone with a on my board? Can that help? Doesn't necessarily have to be like an official board. Also, maybe right have things like an uh, executive committee or things like that that you could probably align so that you have some sounding person to go out to in an official manner, and that is something that I would surely yeah, stress on.
How much does a board cost annually? Ballpark?
It depends.
A good board. Right.
Like a good board, you can anticipate anywhere between, depends on what size of scale you are, but between 1 to 5 lakh a month, you can anticipate. So typically, right, it comes back in the size and scale of where you are. If you're, it's that gap of a product manager or a senior or a product head. Can your
Right.
product manager, can you optimize him to take you to the next level? But can you reallocate that capital and getting someone on the board? Start with one, add two as you scale.
And should you give equity for getting people on your board? Like a lot of people want advisor equity. Do you believe in that advisor equity concept?
I personally believe equity is more expensive than P&L.
Yes.
So that's me. I'm a little more biased manner. Obviously, everyone has their own thing. So you ask me today, no, I will pay you more upfront or the fee income because that is something that can, it's a tap. If you're not adding value, it stops. Equity once
Advisor
given,
equity, you're locked in for life. Okay.
equity once given, it's just more of a headache. So that's my personal bias. But whatever works. If you're at that stage where not able to even give that kind of fee, do what works best for you. Because no point of having 100% of your equity if your company is going nowhere. But depends on completely on. But my
Yeah.
personal thing is, I no way I'm giving equity. It's charge more, but equity